Rob Luna, gentlemen, is a best-selling author, renowned wealth strategist, founder of Rob Luna Wealth Academy, and CEO of Real Talk Holdings LLC. Rob Luna, the floor is yours, my brother.
Do you want blissful balance in your personal and professional life? Great. What's up, guys? My name is Cary Jack, and I want to help you happy hustle a life you love, one full of passion, purpose, and positive impact. I'm a lifestyle entrepreneur, a professional model / actor, a digital marketing specialist, a podcast host, author, a biohacker, an eco-warrior, a martial artist, a hippie cowboy, and a humanitarian. My goal is to educate, inspire, and entertain you to live a life of passion, purpose, and positive impact. It is time to happy hustle your dream reality. Yee-yee!
Thanks, man. I feel like I've been missing out though, man. Stem cells, sex counseling, and mustaches, man. This seems like where the party's at. I've been in the wrong spot, man. So
This is.
I'm happy to be here and talk to you guys today. I'll get into that in a second, but yeah, thanks for giving me the floor for a second on the Headstrong Project. So this was an organization that was founded about 10 years ago. I became an advisory board member last year based out of New York. And, you know, the project is, and the mission is basically to help veterans, active duty members with mental counseling, mental health issues, because there's just not a lot of good, as much money as we pay in taxes, the services that are being offered to them are just probably the lowest quality that you'd find. And if you look at Charity Navigator, you know, 97% of all the money goes back to actually helping veterans. And, you know, the statistic that really made me wake up is that 17 veterans a day die by suicide. That's a day. And that's just way too many. So it's a huge issue. There's some great people that spend a lot of time selflessly behind this. And so if you guys would like to take a look at their website, the Headstrong Project, reach out to me with any more information. You know, thanks for letting me shout them out, Cary.
Of course, man. And yeah, we do have veterans a part of our Happy Hustle Club, and it is a damn shame. You know, I even think the stats like even higher. Sometimes one of our guys said it's close to 22 veterans commit suicide every day. I don't know which one's accurate, but both are tragic. And it's just
I mean, even 2 or 3 hour, hopefully the goal turns to zero for not just veterans, but everybody. But that's just a staggering number, which is 57% higher than the general population. So it's definitely an issue. And these ladies and gentlemen do a great job at, helping them. Just this success story after another is amazing. So, but yeah, thanks for letting me do that. So yeah, I mean, look, I'm excited to be here. Cary said, "Hey, I've got a great group of guys that invest for themselves, men of God. They want, they want to learn. They support each other. Would you take some time to come and talk to them?" And I just turned 50 years old recently, and so to me, time has become really valuable. And I think for most of you guys, you probably experienced that. So I wound up saying no to a lot more things than I say yes to these days. It's funny. I worked out about 3 months ago with a guy named Gunnar Peterson. He's become a friend of mine. He's a celebrity fitness trainer. He trains The Rock. Sylvester Stallone's one of his good friends. But guy's great. And he was telling me a story, though, because he's worked with Sylvester Stallone for 25 years. Somebody called him up, and they had a charity golf event. They said, "Hey, you think Sly would come out? We'll pay him $250,000 to golf with us on 9 holes." And so he called Side up and asked him, and he said, "No, dude, I really can't do it." And so he said, "Okay." So tells the guy, no, he's not willing to do it. So dude says, "Okay, how about $500,000? So pay him 500,000. This is a true story. 500,000 to come out here." So he's like, "All right, I'll call him back." He calls him back up, and Sylvester Stallone says, it seems like he thought for a moment. He's like, "No, dude, I can't do it." And what he told him is, he said, "Hey, look, man, I'm already," I think he was like 70 at the time. The average age, life expectancy is 74. He said, "What I do is I fill up this jar with marbles. And for each week that I'm going to be alive, and every week that I end the week successfully, I pull one of those marbles out of the jar." And he said, "Look, Gunnar, I don't have many marbles left, man. And it's definitely not going to be a week that I want to spend with some people that I don't know, golfing for some, though. And it's really not a charity I even believe in." So he said, "No." So I started doing that same thing, Cary, and I've got 1,225 marbles left. It's not a lot. So when I pull it out at the end of the week, I really had to think about this and say, okay, is this worth it? Is there going to be an impact that I can make? And so the fact that you guys invest in yourselves, the fact that you guys I believe from what Cary said, put God first and give all thanks to him. That's why I'm here, to hopefully give something back. I know we're going to get into a Q&A, but I'm assuming that not everybody knows me here, because unfortunately still a lot of people don't know who I am. And I'll just give you a little bit of a background. I'm probably like a lot of you guys. I think everyone's got a sad story. Mine's, I kind of grew up really poor, father that left when I was 3, mother that was addicted to drugs, in and out child protective service. I was incarcerated at 17, arrested for attempted murder, and something that I didn't do in Los Angeles, California. But at the time, the neighborhood I grew up knew exactly who did it. You don't rat. So I've kind of thought like, hey, man, this is just going to be the rest of my life. I was in juvenile hall, just thinking, wait, what is this going to look like? I had a brother that was incarcerated for life, who got caught up in gang violence. And by the grace of God, I had a public defender who, because there was no evidence, was able to get me out of there. And I had a wrestling coach at the time. I went back as my senior year in high school and said, man, you got to get the hell out of here. He got me a scholarship to go wrestle in Arizona. And by the grace of God, I really never looked back. I took that opportunity. I got 3 college degrees from some of the best universities out there. I'm an alumnus of Wharton, UCLA. I spent a year studying in Singapore, where I have an MBA at the NUS. I became one of the top ranked by Forbes wealth advisors in the world, top business strategist. I've strategized and done projects for Google, for Microsoft, for Nike. And so I've had the abundance of opportunity, thanks to God, to do some really cool things, manage wealth for some of the most successful people out there. I built my own wealth management firm that was called SureVest when I was 27 years old, out of a bedroom. I didn't have any money. I didn't have a lot of clients. I had some credit card debt. First couple of years, I'm sure like you guys, I know a lot of entrepreneurs, was very humbling. I was washing cars on the weekend for my friend's detail business just to be able to pay the bills. But I kept grinding. I kept my faith. I kept working my ass off. I kept learning. I kept evolving, investing in myself like you guys are doing. And eventually I built that firm up to almost $1 billion under management. I sold it to a publicly traded company in 2020 called CI Financial. And now I think it's the 3rd largest wealth management firm in the world. I helped them roll up my $1 billion firm to almost 140 billion by the time I left. So I think they're right behind Goldman Sachs now. So I left last year. I had an earnout that I had to do, to make sure you get paid. It was pretty good money. So I stayed there for the earnout. Didn't know if I was going to stay in corporate America, and realized, man, this just isn't for me. I'm on TV all the time. I talk a lot of shit. I say a lot of things that people don't like. And I didn't want to change that. And I had like PR nightmares. Their HR department was calling me all the time. And I told the CEO at the time, Kurt McAlpine, I said, dude, I think you want to let me out of here, man. It's just, I'm having some fun, but I think this is going to end badly for everybody. And so I left, didn't really know what I was going to do. I took 2 people with me who I carved out from my non-solicit, non-compete. I said, hey, let's go and educate people, and we'll kind of see what goes from there. So that's why I started my Wealth Academy, to basically teach people entrepreneurship, because without that, I wouldn't be anything. Building my business, being able to sell that for life-changing money. And I've done that for probably about 75 people. My biggest stories, I took someone from a $4 million valuation to 180 million in 36 months. They exited at 39 years of age, 100% sole owner. And I've kind of figured out what the recipe is for doing that. And simultaneously, kind of the cool thing is, I've been in private wealth for family offices for 25 years. So not only do I know how to build businesses, exit and scale them, but I know how to build those portfolios along the way to make sure that you're building something that's going to give you consistent income, so you don't have to worry about ever working again for your life. So that's kind of my unique value proposition, is I understand how to build institutional quality investment portfolios, but I also am really good at scaling businesses, exiting businesses, helping investors kind of take that. I call it, your back pocket is where your business money is, but you got to get that money out to the front pocket as soon as you can with as little tax impact as possible. And that's kind of the balancing ratio that we have. So that's a little bit about who I am. And I don't want to spend too much time talking about that, but I assure you, I'm pretty qualified to talk about, not much, but in terms of portfolio management and building and scaling businesses, I know a lot about it. Like Cary said, I wrote a book called Close Your Wealth Gap. There's a lot of things I'm doing now I said I would never do in life. I said I would never write a book, and didn't want to. And then Wiley kept calling me, and Wiley is just like one of those names. Again, growing up poor, having the opportunity, I read all these Wiley books, cited them during college. I'm like, yeah, they're the biggest publisher of financial books in the world. Maybe I do this one. So I wrote the book, and really the idea about Close Your Wealth Gap is, I'm a big believer in, you can't, the proverbial, you can't give a person a fish, you got to teach them how to fish. So I think handouts, I think the way the government has it all right now is all wrong. I believe financial literacy is the key. I think that needs to start way earlier in life. It's crazy. People with college degrees that don't know the basics of financial literacy. So it's really more about that. That's what the book is. It's really hard to put 25 years of knowledge and experience in the book. I tried the best that I can. I'm good. They've already called me about another book. I'm not doing any more books. I'm done with that. Someone told me, Cary, I think you've done books. You don't make any money at books. It's a big hassle. It's got to be a labor of love. Trust me, you guys. It's funny. People come, hey, I'm going to buy your book. Okay, I get about 3 cents about for every book that you buy.
Yeah.
The big thing is just come back and tell me about the impact that it made.
Right.
Share your story with somebody else. That's the bigger thing I'm interested in. But so what I plan to do today is just talk a little bit. I'll kind of give you an overview of what's the environment look like right now. We've got a new president. There's all this talk about tariffs, what's going to go on with taxes. The market's been an absolute roller coaster, and everybody, I tell people, like, even if you're not going to invest in the stock market, you really need to understand and learn the stock market, because the stock market is a real-time pulse of what's going on with the real economy. And if you understand it well, it's going to tell you well in advance. Like it told me in 2007 that, hey, we're going to have a big crash coming. And really the eye was on real estate. And the challenges, I was pretty young at that time. I got all of our clients who had a lot of rental real estate out of the real estate market. I didn't understand quite the contagion, though, of how that was going to impact every single asset class in the liquidity crunch. And so, like I always say, I've got great education, but my biggest education, my biggest learning lesson, the biggest value I could share is from the mistakes I made in 08, 09, the mistakes I made in 2000, 2001. Those mistakes, I'm pretty good. I only make mistakes once. I don't make the same mistake twice. Some people do that, but I learn from those. I pivot and I adapt. And so, when I see things like the market crash because of tariffs or COVID or all these other things, it's like, I've seen September 11th. I've seen the dot-com crisis. Not when I say seen, I managed real money, and my whole livelihood was connected to the market during those periods of time. I've been through 08, 09. I've been through COVID. There's not really a lot of situations that I can't see. And the truth is, the history doesn't necessarily repeat itself, or what I say, repeat itself. It does kind of play out, though, that the same things tend to happen again, especially, my undergrad's in psychology. When it comes to behavioral finance and the mistakes that people consistently make time and time again, people proverbially, you talk about buying low, selling high. And most people do the opposite when they're managing their own money, because people want to buy when things feel good. And when there's blood on the streets, when you really should be buying and it doesn't feel good, that's when people tend to get scared of the market. And so we're in a time right now where, they say the markets hate uncertainty, because, again, I just told you that the market is a forward-looking indicator, pricing mechanism of what they believe is going to happen in the future. And you can look at, if you guys have traded stocks before, when a stock comes out and reports earnings, they could have blown away the last quarter, like complete blow away. Analysts said 2 cents a share, they did 10 cents a share. 800 million in revenue, they did 1.2 billion dollars in revenue. You would expect the next day for that stock to skyrocket, and it crashes. And you're like, what the hell is going on? Well, it's usually because of the conference call, and where the CEO comes out or the CFO comes out after hours, and they talk about what's happening the next quarter, what's going to happen in the future. What they're trying to do is guide you as an investor of what they think is going to happen, because you're going to price that stock based off of what's going to happen. If you think back at 2007, 2008, it's funny, because if you look at the valuation of the big home building stocks like Toll Brothers, KB Homes, and you look at just PE ratios, they were actually pretty cheap. But when you think about that, I just told you, everything's based off of the past. They were pretty cheap because why? Everybody and their brother was buying a house. They had liar loans, all these things. So you could buy 2 or 3 or 4 homes. So they were so cheap because there was an expectation that that was going to be able to continue forever. We all knew that that wasn't going to happen. And so it looked like a 12 PE was really a negative PE, or a 2000 PE. When all that happened, everything crashed. So the idea is about being a business owner, about being an investor, whether it's stocks, real estate, cryptocurrency, alternatives. You have to be able to predict the future. And it's very, very difficult to do that. So we try to use every tool that we can. So I think I'll speak for myself. When Trump got elected, everyone was kind of optimistic about, okay, things are going to be exciting. We're going to have deregulation. We're going to have big tax cuts. We kind of knew what was going to happen with tariffs to some extent. But I think kind of the animal spirits, my friend Charles Payne, who's on Fox talks about all the time, being reignited was going to be there. When we looked at kind of the opposite candidate, it was all the opposite, right? It was raise taxes, punish small businesses, give more handouts, and the things that most of us as entrepreneurs believe weren't going to be good long term. And I won't get into any of the other issues, but let's stick to the financial issues, right? And so when we looked at that, we got pretty excited. And then Trump came into office, and anyone who's read Art of the Deal or anything new, it wasn't going to be predictable. Trump is not a predictable person. The way he negotiates is very different. I love the guy and hate the guy at the same time. I think a lot of us have that relationship with him. But at the end of the day, he's been pretty good at what he does. Now, do I think that, like some people believe, this is a big master plan of how he was going to negotiate everything? And I think maybe I know too many people that are too close to him. I don't think that was the case. But I think he wanted to kind of get a feel of what was going to happen. So if you've noticed, he's kind of pivoted from his plan at points of time of inflection where he needed to. When the 10-year started getting out of control, when the market started tanking a little bit too bad, he even called the bottom on the stock market, at least the most recent bottom at some point in time. When you look at what he's doing with tariffs, a lot of other things in terms of tax cuts that he wants to put through with his new bill, a lot of different reforms, cutting the fat out of government with DOGE, which I think is a great thing that's long overdue. I think these are principles that long term are going to be really, really good for this economy. Now, the thing about data and statistics, you guys being educated will know, like I can say anything and find a data set to validate that, right? Mm-hmm. And so everyone's talking about how and if you follow economics or you follow the stock market, Moody's, these ass clowns, just came out and they downgraded the U.S. debt. 14 years after S&P did. These are the same guys that were like giving AAA ratings to Lehman Brothers and calling subprime mortgages in 2008 credit-worthy investments. So like, I think their credibility has been shot. So obviously it was a political statement, but they came out and downgraded debt because they did this really back of the napkin simple analysis of, okay, you put these tax cuts in and you grow at like 1.8%. And so that's the key metric though. If you grow at 1.8%, which is really above what we should be growing at in terms of GDP, if you get an economy that's going on fire in the US, there's no reason we shouldn't be able to grow at 3%. Under the old policies, 2% was kind of the ceiling. But if you start getting these things that are going to inspire people to invest, that are going to incentivize them to invest, you're going to get people putting money back in the market. You're going to get M&A. You're going to get all these things going on. And if you actually change that number from 1.8 to 3%, the whole table changes. And you start to see like, wow, we could actually get ourselves out of this. So all these things are good long-term. Now let's talk about short-term though, about what are tariffs going to do? Let's talk about the valuations. Let's talk about, is anything cheap or what's expensive? Where should I invest my dollars right now? So tariffs in the short run, guys, they are a tax, okay? At the end of the day, they're a tax. Like I consult with small business owners, and one of the biggest flooring distributors in Southern California is a client of mine, friend of mine. He is at the heart of this storm. This is a small business owner. He's wealthy, but not wealthy in terms of what we're thinking in terms of numbers. He employs about 26 different people, and the vast majority of his products come from Asia. A lot of them come from China. And so he's somebody who was absolutely decimated at the beginning of this year. Did he pivot? Yes. Did he move some of his supply over to Thailand? Yes. Other places? Yes. Cambodia in particular was able to pick up some of that because they didn't have that 145% tariff. But let's be honest, guys. He'll tell you, when you go to Cambodia, it's Chinese restaurants everywhere, Chinese signs. When the 2017 tariffs went into place, all the Chinese moved their factories over there. It's Chinese that are running it. They're speaking Chinese. So make no mistake, it's still China that's importing this. So they already knew, and we already had the tariffs in place of 25% from 2017. Those never went away. Then we had the fentanyl tariffs that went in. So there's been 45. This is another 10. So tariffs are actually at 55%. So a lot of people don't actually realize that. So that's been a tax. Now the 45% though has been adjusted. The 10% he's actually already gotten concessions on. So he's actually got slightly higher margins. The 145% though is kind of a deal killer in the short run. And it's great in theory to say that we're going to bring all manufacturing back to US and that we're going to create all these jobs. But I think you guys know in reality, it's going to take decades to do that and probably a unicorn to make this happen in the time span that we're talking about. Not going to happen. And then also, unfortunately, these people who are, on either side got a politics. I feel like there's people who will go homeless before they go against the right or the left, right? So on either side, these people are like, oh, we're bringing good jobs back. And I think if you know what's going on with factories and artificial intelligence and robotics, unfortunately, for us to be able to compete with China, it's not going to be our labor force. It's going to be robotics and robots that have worked 24 hours a day will increase productivity. That's the only way we're going to be able to compete with child labor and all the other shit that goes on out of this country. And this is someone who studied for almost 2 years in Asia, right? And I understand how Asian economics work. I understand how you have to negotiate with them also. It's not diplomacy. So actually the way that Trump is negotiating with it is the way to do it, but you just have to be aware and understand what are going to be the impacts and repercussions associated with that. So I'm not saying it's bad. I'm just saying understand what it's going to mean in the short run. So companies will have to pass on price increases if they have, these are not non-for-profit organizations. Before they came out and rolled back after the meeting Scott Bessent had, Treasury Secretary, the 145 to 10%, I've got a Vaultex desk safe sitting next to me here. And in my safe, I buy a lot of Vaultex stuff. They sent me out an email like a week before that and said, because of tariffs, we got to raise prices across the board by 25%. Okay, the day Scott Bessent said that, I got another email and said, price increases are on hold right now until we know what's going to go on long term, because we could take 10%, we can't take 145%. These are just microcosms of what's going on in the real economy that you won't hear on CNBC or Fox Business or any of those things. So people are impacted. Will you pivot and adjust? Yes. The big businesses, I'm not worried about. And so when Trump talks about some of these things, big corporations, they'll lay off, they'll do whatever they need to do. But the backbone of America, the people who I'm worried about, who I am, who a lot of you are, small businesses, are getting hurt for it. And that's why, I'm a little bit upset in a sense that I get it, but I personally would have started with tax cuts. I would have started with the border, yes. But I would have started economically, I would have started with tax cuts. I would have started with some of the deregulation. I would have started with some of the things to get the economy up and running and get those passed first before I started with this tax and implementing uncertainty that was going to get people scared. Now, the market has bounced back because I think they've done a good job of seeing the collateral damage, kind of pivoting from there. I believe they're going to come up with some kind of deal. And I believe if they can do that, if they can get tax cuts passed, if they can start to make M&A happen again, if they can lower regulation, which regulation being from the financial service industry is a huge burden and tax on small businesses. If they can do all those things, I think we're setting up a stage for huge growth.
Whoa, whoa, whoa. Apologies for interrupting your programming, but I have to tell you, the best investment you can make in yourself is one in which helps you acquire skills. You've probably heard people talk about, oh, just invest in yourself and you'll be successful. Yes, that's true to a degree, but you have to invest in skills that will ultimately help you achieve your desired results. And I think one of the best skills one can possess, be it an entrepreneur or an aspiring entrepreneur, is the sales sword. Really knowing how to sell, utilizing pressure-free persuasion, which will make you more money and more impact. Now, if you want to know how to sell more efficiently and effectively, I just launched a sales course called The Proven Roadmap Process to Selling Millions of Dollars and helping you to increase your conversions, guaranteed. And you can get access to this new sales course that The Happy Hustle is launching at thehappyhustle.com/sales. And if you act fast, you'll get it at the lowest price it'll ever be available, because we are launching it and we want to gain amazing testimonials and social proof to further share this knowledge. So if you act fast, you can get it at the lowest price it'll ever be. That's at thehappyhustle.com/sales. Now let's get back to this episode.
The only challenge I have is, and I'm a majority owner in a wealth management firm. I have a business consulting firm, an education firm, all tied around money. And I benefit when the stock market goes up. I benefit when people invest. And I have a lot of people that I advise that are asking me, like, Rob, is this the time to put more money to work? Is this the time where I start leveraging things up now that Trump's in office, or people that are excited? And the challenge is, if I'm honest with you, when I look at the stock market, when I look at the real estate market, when I look at most of the alternatives that are out there, oil and gas, I collect a lot of things. I collect a lot of first edition comic books and sports cards and fine wine. And I just like those things because I could see them and feel them and touch them and autos and things like that. And so all those things right now are pretty expensive. Like there's no, by any value metric that you look across the board, there's nothing out there that's super cheap. Now, during COVID, super cheap. During 0809, like, dude, we could find businesses that were trading for less than the cash value on their balance sheets. That's an opportunity. That's what discounts look like. So what I've been telling people is, look, your long-term money, I continue to invest in my 401k every 2 weeks. I've got my Roth IRA. I've got my long-term portfolios. I heard you guys when I was coming on talking about dividend paying stocks. So I've got a portfolio that has dividend paying stocks and master limited partnerships. And this portfolio, I've been running the same model for 16 years. While it's gone up and down different years, I've never had 1 year in 16 years where this portfolio hasn't given me a raise, because these companies raise, their REITs raise, all of these companies. So dividend yield, I always tell people, that's what you want to focus on your retirement plan. Or I don't call it retirement because I work with so many people who can stop working in their 30s. I call it work optional. And your work optional program, what you want to focus on is creating that passive stream of income that you don't have to worry about, that's going to be consistent, and that's going to grow every year to be able to keep up with inflation. And so there are those types of investments. And if you can count on that and not have to worry about capital appreciation, because like if you take a look at Procter & Gamble's a great stock. Take a look at Procter & Gamble's stock chart like over the last 70 years. It's kind of like this. It's up and down, but from the left to the right. But we've had some bad years in Procter & Gamble. Like during the flash crash in 2011, I think Procter & Gamble lost like 25% in one day. So capital appreciation, you can go up and down. But if you chart the dividend yield, what the payout was to investors over that same period of time, it's from bottom left to upper right. They've never not only missed a dividend payment in over 60 years, they've never have not increased that payment. So those are the types of things you're looking at when you're putting together a portfolio. My goal always is to get people into retirement where the old just live off the principal. Like that's what we're really trying to do. And a lot of people don't manage money that way. The financial service industry is horrible. Most of the people that are out there at Merrill Lynch and Morgan Stanley don't know what the hell they're doing. They're really good salespeople. They've got a couple of analysts in Wall Street that put together these model portfolios. They don't want their people out there really spending time learning the market. They want them out there collecting assets. And they put them in this cookie cutter model, and they tell you to take a 4% distribution off of that because over this 100-year period, that's happened to work. And if you want to sue them, you're not going to be able to get sued because they're not going to be able to win because everyone's doing the same thing. And so I think there's a better way than that. I've managed money for a better way than that for years. I think most people can do it themselves better than what those people are willing to do. And so when you're looking at today, like what should you do with your money? I would say like stay put in those long-term assets. Look for some of the dividend opportunities that are out there. There's still some good ones. I think, some of the biggest opportunities though that I'm investing in, that I'm advising my clients on, are on private businesses. Because private businesses are at the lowest in terms of everything I look at. You could find some of the best deals there. You have a lot of people that are not sophisticated operators. You have some people that haven't really put scalable solutions in place. So if you're willing to roll up your sleeves a little bit and do a little bit of work, and you can find something that's synergistic with what's in your, for example, if you're a landscaper, if you can find another landscaping business that's in your area, those are the types of things I'm advising people on. So I know I've been talking for a while now, Cary, and I can go on forever. There's a lot of things to talk about, but let me open it up for Q&A for you.
Yeah, let's open up for Q&A. I mean, as you guys know, Rob is a wealth of knowledge, and we could go in so many different directions. I mean, personally, I know everyone on here is an entrepreneur. We all have a business, and they're like talking macroeconomics. Sometimes I feel like for me personally, I'm like, shit, how does this really affect me right now? Yeah. And what do I need to do differently to prepare? That's like kind of in my mind, because, sometimes it feels a little bit obscure. Like, I don't know, there's a big chasm So I don't know if anyone else feels that, but I do want to open it up for questions, and then I have a question towards the end if no one else has one. So Justin, you got a question. Do you want to unmute and ask Rob? And guys, this is your time. Rob gets big bucks for consulting. So this is your time to get your answers for all things wealth and tax and strategy. And just, yeah, it's a good opportunity. Justin, go for it.
Yeah, sorry guys, I'm watching my 5-week-old here too, but no, great information by the way. But the one thing I was going to ask you is we're kind of paving the way for an exit in probably 3 to 4 years here, and I know you had mentioned that you have a system that you kind of use continuously with different companies, and I just wondering, is that outlined like in your book or anywhere else where I could get some information on that?
Yeah, no, to be honest, it's not in my book. I mean, that would be a big book that I'd have to write in terms of how to scale businesses. It's more about personal finance. It does talk about entrepreneurship in there. And that's kind of where I spend most of my time now in my consulting businesses with that. But let me kind of give you I'm happy to give you all the information, kind of the roadmap of what I look at when I start with someone like yourself. First of all, and I advise also a lot of pre-revenue businesses, right? And I've actually sold for high valuations businesses that have made hardly any revenue, never had earnings, right? So what we do is, when I would go and work with you, is we'd figure out who is going to be the acquirer. It's one of the most important things. I always start with the end in mind, right? We work right to left. Even new businesses. Okay, what is our exit strategy? Like, we don't even have our business plan done yet. Okay, we'll do that, but our business plan is going to be largely dependent on what our exit strategy is, right? If you're looking to sell to a startup, if you're looking to be acquired by a strategic, if you're looking to go public, our business plan has to align with that. So as an entrepreneur, you should always be thinking about from the beginning. If you haven't, think about it now. What is my exit plan? And for some people, I have clients that are huge realtors, right? They're making literally $7-8 million a year. They don't really have an exit strategy. They're not in a business that's going to have any value. So their exit strategy is save 70 to 80% of that for the next 10 to 15 years and build that portfolio, which would equate to an exit for 40 or 50 or 60 or $80 million. But for the rest of you who are building something valuable that's scalable, you want to figure out who that is. Is it internal succession where you're selling to family members? Is it a strategic? Like I said, are you a landscaping company that you're going to sell to a bigger landscaping company? I do a lot of sales to private equity. Private equity is in everything now, like the Blackstones, the KKRs. They're buying HVAC companies. They're buying coaching companies. So are you selling it to private equity? Are you selling, like I sold, to a publicly traded company? So once you figure that out, and the way I do that is I've got a lot of friends, right? I'll call all the public, like if I'm working with you and you say, hey, I'm in cabinetry. Okay, so I'm going to call the people I know in private equity and say, give me the last 10 deals. What did those companies look like? What was the profile? What was the metric? What was the EBIT? What were the systems that they had in place, right? I want to know who those buyers are because I want to make you the prettiest girl at the prom, right? I want to make you look like the easiest choice if they're doing due diligence on 3 or 4 companies. If they're using Salesforce, I want you using Salesforce. If they run their strategy session, I want you to look exactly like them, because if you do, your valuation is going to be way higher than somebody they have to go in there and rework things. So I can spend a lot of time talking about just that segment. I do spend a lot of time with people, but think about what that is. Then what you have to do is figure out, well, where are you today? Very simple. Where is the gaps? What are the things that I need to do to change to look more like that company, right? And then from there, you have to start putting those systems in place. And what I tell every single customer that I work with, no matter what industry they're in, you want to look like Microsoft 365 as much as possible. What I mean like that is, like, I just pay for Microsoft 365. For a lot of people, I don't think about it. It just gets paid. I don't know. Does anyone answer a phone if you had to call? I don't know, right? If I was going to buy that company or even Netflix, it's pretty easy. Like, I know Reed Hastings is the CEO of Netflix, but I don't really care, right? I think Netflix can run without Reed Hastings. So the same thing is, you want to understand, okay, from going A to B, how do I first take myself out of the equation? How do I get this business to not only be sustainable without me? That's the first thing as an entrepreneur, right? How do I go on vacation for 2 weeks and not have my business fall apart? Like, you got to do that first, right? But then you got to go from that stage to, how do I now go on vacation? Not only will the business not fall apart, but will it continue to grow, right? Yeah. And so you want to start thinking about those things. Again, I'm sorry, this is a long answer, but it's very important if you're entrepreneurs. You want to start thinking about those things. And do I have the right systems in place? Do I have key man risk? Is this attractive? Am I doing the things that these exit companies look like? That's what we're start doing. And then, but what I also do with my clients from a personal situation, this is where a lot of entrepreneurs go wrong. If you want to exit to 3 to 4 years, well, if you lived in California, I'll tell you, dude, like, let's go to Nevada, or let's go to Tennessee, where I moved to from Southern California, or let's go to Texas or Florida, somewhere where there's no state income. Let's start putting trusts in place. Let's start doing things to minimize that tax. Because if you've got a $10 million exit or $5 million or $100 million exit, you obviously want to keep as much of that as possible. And if you don't do it the right way, you're going to lose so much money in taxes that it's crazy. So those are the things you need to start doing. And it's way better when you can get to a company pre-exit than post-exit. Because once the deal is done, I had a lot of people say, hey, I just sold my business for 20 million. And then you tell them after tax what that is. And then you tell them what that turns into in passive income. And it's half of what they were making before they sold their business. It's like, dude, this is why you should have come to us a long time ago. I promise I would have more than paid for myself. So long answer, and there's a lot more to it. I love talking about this stuff, but I want to be respectful. I'm probably already over on time.
Yeah. Well, and Rob, maybe if it's cool, we can drop your contact info for any guys who are watching the recording, or guys who want to go a little deeper and just learn how you could maybe support in that process, because there is so much to cover on that, Justin. But was that helpful, Justin? Just high level?
Yeah, I appreciate that. Thanks a lot, Rob.
Yep, for sure.
Phil, you want to go next? Ask Rob a question.
First of all, only a true entrepreneur would know that a milestone in business is being able to take a 2-week vacation. When you articulated that, I was like, oh man, I remember that. I do. It's incredible. Anyway, my question's around finance. So as it pertains to generating income off of a nest egg, selling premium is a popular strategy. I know enough to know that it's pretty intricate and you can lose a lot of money. So there's a whole new world of ETFs that's doing covered call strategies, put credit spreads. Dividends are much tastier than your traditional dividend paying stocks, but it's new. Have you looked into these? Thoughts, comments, concerns?
So lucky for you, I was an options principal and derivatives trader for a hedge fund for 4 years before I worked with institutions. I could really, I didn't talk about my whole career, obviously, but I was an institutional and derivatives trader for a hedge fund for 7 years before I worked with retail investors. So, and a risk manager. So I understand a lot about it. And so I don't want to bore everybody. Covered call writing and premium is basically when you own a stock like Microsoft, you could sell somebody the right to buy that at a certain price at a period of time, and they give you a dividend for doing that. If it reaches that, you have to sell them for that. And so it is a way that you can generate income. I'll tell you, as someone who's run a covered call levered buy right strategy where you buy the stock, sell the call against it, it's not consistent income and it could go against you, right? And when you look at some of the ETFs, what they're doing is they're encapsulating the last quarter of premiums and volatility and all these things. And so the yield that they'll be showing you, I can promise you, is not a sustainable yield. So a lot of people get tricked into that, like, oh, I got a 10% yield here. You do now, but that could be a negative yield the next quarter. So when I build investment portfolios, like in my industry, they show you these Monte Carlo chart. Like, I hate anything black box. I want to, in my clients' portfolios, I could point to every stock, every bond, everything to know exactly where their income is coming from. So if there's any problem with their income, I'm going to be able to pinpoint that. If it's in an ETF, I don't know what the hell's going on. I'm going to have to sell that ETF. So Philip, the answer is I'm not a huge fan of it. There's way better ways to distribute income. And you're an entrepreneur. And that's what I always tell entrepreneurs. Like, I have a bucketing strategy that I teach my Wealth Academy members, where your bucket one's, safe, your bucket two's your income, 3 is your growth, and your 4 is your high spec stuff. Like, I always tell entrepreneurs, like, you've got 3 and 4 covered. Focus on 1 and 2. 1 meaning you've got cash to weather a downstorm for a year, because you might not be able to take a vacation. You might not be able to pay yourself if you're a good business owner. But then secondarily, build that bucket 2, the passive income stream, because what that allows you to do is start getting some of that passive income to kind of take a little bit of stress off of you. Like, that's one of the things, being an entrepreneur is freaking stressful, right? So when you can start building that portfolio of good, consistent, growing income, I'm really, really focused on the quality of assets in retirement and the distribution. You can build a portfolio higher than what they tell you for it, but you can build a really good portfolio, 4.5% to 5% of just yield. That's growing, not like a 10-year bond. But covered calls isn't something that I personally love for that.
info. Thank you.
Yep.
Yeah. Yeah. And just shout out to Rob has like a whole lunatic investors, you know, community that he goes through a lot of this stuff to that goes deeper on all that, Phil. So maybe we can link it all up and we'll put in a recap email tomorrow too. Cool. That goes out to everybody. I know Tim had a question. Rob, you got time for another by chance?
Yeah. I've got another 15 minutes. So whatever you guys have, I'm good.
Okay. And guys, if you do have to drop, just feel free. I know we typically close it at the 30-minute mark, but now is a great opportunity to learn from a true expert. So, Tim, you wanna ask Rob a question? And by the way, Tim's in Nashville. Y'all should get coffee or something.
Cool. I was just about to say, fellow Nashville guy. So, would love to connect. But Rob, thanks so much. My mental model as I think about investing, there's liquidity. Yep. There's time, there's tax. So like, given that most of us are entrepreneurs, we own our own businesses. Curious your perspective on, call it, there's very few things that are truly passive, right? But the liquidity piece is really kind of an important one in my eyes. The public markets, you ride the rate, you ride it up, you ride it down, given volatility, et cetera. But you mentioned that small and private businesses are an area that you're looking at. I just think for the group in general, we know our own businesses, but can you give some ideas or thoughts on like where, if we want to continue to run our own business, but also still have exposure, how you might think about that? Because I think for most of us, we've got a lot of wealth tied up in what we're doing now, but if we can take some distributions, dividends out of what we're doing and put it elsewhere, maybe, looking a decade plus down the line, how you would think about that, if we don't need the money today.
Yeah, great question. So that's the thing, right? As an entrepreneur, like I said, the first thing you want to do with your investment is have that security blanket, right? The good thing about a security blanket today, if you look at money market accounts, T-bills, which I invest in, which are basically just money market accounts, you get a little bit of a spread. You've got full liquidity and you're getting like 4.6%. If you looked at that like 3 years ago, it's like nothing, right? You're getting nothing to invest in money market accounts. So the good thing about today, why I'm telling people still like be really selective before you deploy dry powder, is that you can really get paid to wait where you couldn't do that before. And that's what the Fed was trying to do, right? They were trying to keep rates low to force everybody into risk assets and what they did. But today is a good time to stay in conservative assets because you're getting almost 5% to not take any risk, right? The risk-free rate's 4.5%. So I said, like, that's the first thing you should do. And this is a time where as an entrepreneur, like the rule of thumb that financial advisors say, have a 90-day emergency fund. I tell entrepreneurs a year to 2 years. You want to have a year to 2 years of what your living expenses are inside of a money market account, T-bills, things like that, to your point, that are safe, predictable, and fully liquid. That's kind of your liquidity chunk, right? And then in terms of
real quick, Rob, the T-bills.
Yeah.
And money markets, just a little more specificity because I'm like, I think I know what T-bills are, but what the hell are T-bills?
Yeah, so money market account basically is an account that you can get anywhere. Like we use Charles Schwab primarily for our clients. Okay. I think Fidelity has them. Everyone has them. They're fully liquid. Think of it as a savings account. You put your money in there. You can get it out at any time, no penalty. And the yield is somewhere around 4% plus right now. Okay. T-bills are government treasury bills that are dated typically under 90 days. Fully liquid, one of the most liquid markets of anything in the world. That's what the money markets are actually investing in. And they're earning 4.5 and they're giving you 4. So if you got a lot of money, like people I work with sometimes, they'd write that 0.5% means something, right? So what they do is they invest directly into the T-bills. So that's
Thank you
what that is.
Okay.
Now in terms of other businesses, Tim, I see it, it goes back to what I talked about before. What I'm looking to buy, and what I advise my clients, I'm involved with 3 M&A deals right now. What I advise them on is what we're trying to do, and everyone's trying to do, is buy a steady stream of growing predictable income. When you're looking to buy a business, you want to buy a steady stream of growing predictable income. The more predictable it is, the more valuable it is. The less predictable it is, the least value it is. So whether you're thinking about selling your business or buying a business, that's going to come into play. So I said HVAC, I think a couple of times, just because it's such a hot area right now. Because look, here in Nashville, like it gets hot, humid, your air goes out. You're not going to sit there and wait until it cools down, right? You're going to call somebody. And if you look at the supply demand, there's a huge shortage of blue collar workers in general right now. Oh, true. In particular, HVAC owners are getting called all the time. So premiums, if someone knows what they're doing, are kind of high to buy them right now. But that's a steady stream of predictable income. The thing I'm worried, I didn't have a chance to talk about, but on what I'm most worried long-term for our economy, and now long-term is 3 to 5 years, not 10 to 20 years, is artificial intelligence. It's going to really, like, people are underestimating the impact of what it's already having, how many jobs have already been lost, and what's going to happen over the next 3 to 5 years. Now, not to say that HVAC workers can't be displaced or blue-collar workers can't be displaced, but it's going to be a lot harder. It's going to take a lot longer. It's probably not going to happen exactly in your lifetime or lifetime. So those types of jobs that are defensible, those types of careers that are, those are the things that I'm more interested in investing in right now than something that could be outsourced or taken over by artificial technology. But yeah, again, the valuation of buying a business within something you're doing, though, is very attractive. Why? Because you get economies of scale and scope. So like when I buy another wealth management firm, I don't need their financial advice. I don't need some of their financial advisors. I don't need their chief compliance officer for sure. That guy's gone. There's a lot of things that a lot of their licensing I already have myself. So the valuation when I go and buy them versus somebody who's going into a new industry, it's way better for me because I'm able to go in there and increase EBIT by 25, 30% just through economies of scale and scope. So these are all the things, again, I'm not trying to sell you guys on my academy, but I teach my academy members, we go over, but in the consulting, these are the things that I work with people to kind of help them build and scale, but just a way to think about it. Again, sorry for taking so long, Cary.
No, you're good.
No,
man.
that's super helpful, Rob. I heard a stat yesterday of, for Y Combinator graduates on your point of AI.
Yeah.
If you looked at pre-AI, the number of graduates that hit a 10% month-over-month growth rate in year one was less than 1%.
Yeah.
So call it 1 out of 140 each year. The most recent class, which was AI first, it was 140 out of 360 graduates are now hitting a 10% month-over-month growth rate. They are requiring AI first. They won't invest anymore.
Yeah.
Wow.
Well, I mean, that's,
it's so true. You're exactly right.
The secret sauce, what I tell all my guys that I work with in consulting is the way you need to build a business today is this. You build it with a small team of all-stars because all-stars are really hard to find and the good ones don't want to go and work for you, right? So good luck. And that might be between 5 to 10 people, depending on your industry. I'm building, we're a startup. We just started last year. I've got 10 investors. Like we're still trying to find our all-stars. It's not easy. I got 5. I need like 7 more, but you got to build it with a small team of all-stars. You then need to put in all-star processes, right? That anyone can follow. In particular, technology could follow. Now today, a lot of those all-star processes are being filled by average, I hate to say it, expendable people. People are going to come and go. They're going to be the 9 to 5. They're not going to really add any value to your business. But eventually what's going to happen, it's already happening in some segments of my business, they're going to be replaced by artificial intelligence, like paraplanners, for example. The chief financial officer, our long experienced certified financial planners, they're going to meet with the client, but they're kind of like the doctors. They're not going to take your temperature and do all that little stuff. So we call a paraplanner to go in there and do that stuff. But dude, we have technology now that's way better, that gets it done faster. It's more accurate. That now that's someone that used to make 65, 70 grand a year. Now let's just say the equivalent's about $3,000 a year. And that's really what businesses are doing right now. All-star team, all-star processes, and then just look quickly of how do I turn those all-star processes to be able to be executed through technology, because that's something that's super sellable.
Yeah, I guess just kind of piggybacking on that. So I work a recruiting business with like tier 1 VCs like Sequoia, Sutter Hill,
right.
And pre these like Gen AI new startups, like the ones that are coming out now that are kind of in that space, 3x valuations over like any other business. One of our clients, Augment Code, is on track to be like the fastest $100 million ARR company like of all time. And they're doing like these AI software agents, super small, high performing team in the Bay Area. Like it is crazy the leverage these guys are having with these small performant teams and these AI agents nowadays is nuts.
Well, I mean, it's necessary, right? Because it's entrepreneurs are looking to invest. If it's a person, it's like, okay, what value are you going to bring to my organization, increase the bottom line? But more than likely, it's going to be a technology, right? So you're looking to find a technology that's going to increase productivity. So this is bringing value. It's not an expense. They're not looking at artificial intelligence or technology as an expense. Right, I got a lot of people, and I sold company to CrowdStrike, the cybersecurity company, 5-6 years ago. Like, no one's cutting their CrowdStrike budget or their Palo Alto budget, right? No one's gonna that's the last thing they're gonna say. Oh, sorry, customers, we're gonna make your data a little bit less secure because we have cutbacks and tariffs. Like, and again, from an investment thesis, those are the types of things I'm looking for. So that's kind of really what you need to look at in terms of what you're buying and how you're building and structuring your business for sale.
Yeah. Awesome stuff, Rob. Thank you very much for your time, brother. Any other quick questions, Scott or Steve, or anything real quick that is top of mind or burning?
Yeah, feel free to reach out to me with anything,
Rob,
guys.
what's the best way for people to contact you? I mean, and what can we do to support you and what you got going on?
Yeah, if you go to robluna.com, it's kind of hard. Go there. It kind of has everything, pretty much everything that I do. Take a look through that. Instagram, it's Real Rob Luna. Twitter, it's Real Rob Luna. I am launching a podcast called The American Capitalist. That's going to launch on July 4th. And I've got some really cool people lined up. Tim Grover. I've got Michael Chandler from MMA. I've got Charles Payne, some really cool people. So if you guys support that, that'd be great also.
Yeah, man. And check out, Rob was on Sean Ryan's podcast, which is a huge show. That's a great episode. And yeah, Rob, if it's cool, we'll connect offline, and then maybe there's a direct contact for some of the guys who maybe are interested in a little higher level.
Yeah, my email is rob@robluna.com also, if you want to email me.
Okay. Yeah. Awesome, man. Yeah.
But we can connect also. But yeah, thanks for the opportunity, guys. Good luck.
Thank you, brother. Let's clap it up for Rob.
Appreciate it.
Gentlemen, this has been epic, Rob. Really appreciate you, man. You're a true happy hustler, and we just appreciate you, man. So thank you all for being on. God bless. Peace and love, everyone. Great meeting, and keep on happy hustling.